So this is very important question in this time because we all are trying to figure out whether is this a good time to invest in real estate or not. And then that's why I thought it might be a good idea to do a webinar on it, why multifamily real estate investing might be the ultimate inflation hedge. And the reason to say this is because every day we hear prices are going up or down, and the stock market is a few hundred points up and a few hundred points down. And we want to consider, like, is this an asset class which we can include in our investment strategy to help us grow our wealth? So just so you know that before we get started, this webinar is for education purposes only and should not be considered legal, accounting, or investment advice. The information in this document does not represent an offer to sell or solicitation of any kind of investment or security. Please consult your attorney, financial advisor, CPA for legal matters, investments, and specific tax situations. And after having considered this, I think it is important that we understand the limitation of the talk. Although what I'm talking about is based upon my experiences and everything else which is related with it, I want you to be aware that there are situations which apply specific to you, may be better cleared by professionals which you deal with. So in this webinar, we'll discuss our investment strategy, processes, mindset, and the whole idea is to create a success. For you to be successful, to have wealth, and to have fulfillment. And you will learn how to achieve financial freedom in general. So it's always a great idea to put your focus where you want to be, because where you want to be, that's where you will end up. So year over year, price changes have happened. You'll see NASDAQ has gone down by 30%, S&P by 15%. Cash inflation, if you see, if you put your money in the bank, has gone down by 8%. Bitcoin has gone down by 73.4, over 73%. But there is something positive, that the home prices have gone up by 6.6%, and rental rates have been going up anywhere from 8 to 12% wherever you are in the country. So what we focus on is passive investing. And passive investing means, as an investor, you are able to use all your abilities to do whatever you do on a normal daily life and allow us to take care of the investments where we generate income from the investment without your significant active participation. And a passive real estate investment does not require an extensive effort from the investor. And a passive real estate investor, it allows you to gain extra cash without having to manage property yourself. Now, this can be very challenging to even absorb. It's like, why would somebody go and manage the properties for me and then pay me most of the profits? Yes, 70% of the profits generated from this, most of the time 70 to 80%, that goes to the investor. So you are always in a positive game whenever you are investing passively. So what is an inflation? And like, you hear this word again and again. And you hear this word on radio shows, TV. Oh, inflation is happening, inflation is happening. So basically, inflation is a situation where rising prices in the economy. And a price can rise basically due to several reasons. One is if the supply is not there, or the demand goes up. So it means as the time goes on and inflation goes up, your ability to buy, so let's suppose for $10 you could buy 2 gallons of milk. Now you can probably buy 1.5 gallons of milk. So you spend more and more amount of money to get the same and same product. Now, how can we turn this around and use it for our favor? So if we own a lot of real estate, as you can see here, rising inflation can signal basically an expanding economy. And as unemployment grows, the demand for goods and services go. But there is kind of like an upswing which we can benefit by, primarily, especially if we own rental properties. Regardless of the cause, you will see the inflation will erode the purchasing power of the dollar. So that's why you see Feds have increased the interest rates because they want to curb, they want the dollar value to be there. As a result, the inflation hedges are important. So what happens in the case of rental income? As you can see, the rental income goes up significantly. Even there is a divergence from the curve based upon the CPI rent growth versus the observed rent growth. And primarily it's a demand and supply situation. So the demand has exceeded based on the supply, and there is a huge demand of rental properties. So how do you hedge against inflation? You can buy gold, and you can see the gold has done 9.48% or over a compared inflation of 2.4 to 4%. Netting average 7 to 8%. You can invest in stock. Average returns are about 7 to 8%, and based upon which stocks you invest in and what you believe in, that can result in a savings for you, and you can have a good growth. But then there is also a increased risk of having your money go down by 30%, 40%, which takes another couple of years for you to get back that leverage. Invest in I bonds. If you invest in that, you would have your money locked up for a certain period of time, and you will have some kind of interest penalty if you try to cash the money out. Or invest in the property, means that the investor who owns the home no longer have to worry about rising rents, or in fact, if the rents are rising, they benefit from it. And instead of, you can also help investor fight the effects of inflation. So if you not only do it for yourself, but do it for others, you can have the other investors invest in it, especially if you're investing in apartments, because there are a larger set of homes together. So apartments are like multifamily dwellings. So it can be anywhere about 4 to 400, 500,000 units. So how is the multifamily inflation hedge? It's very difficult to understand that from an outside perspective. But in general, the basic thing to understand is that multifamily real estate investment is a kind of necessity of the society. You need a place to live. And there are very few times when the multifamily investments have failed, and that's primarily from the financial perspective, but not from the investment perspective itself. So unlike stocks and bonds, it's kind of like a defensive strategy, massive range of advantage over your taxes, and doesn't has that much inbuilt volatility as you would see. Sector significantly benefits from supply and demand imbalance. And the way you have to understand the supply and demand imbalance is that when you go in, and let's suppose you want to, like I was talking about recently, someone was telling me about a specific city in Oklahoma where they suddenly moved 700 people because Pepsi, 700 families. Now those 700 families need a place to live. There is no shortcut. You cannot just build these homes overnight. So those people would have to stay probably in an apartment for 12 to 15 months before they can really go into their own homes, if they are capable of buying homes in a rising interest rate environment. So investing in multifamily or apartments in general has numerous outcomes, especially even in recession. It's kind of helps you. So inflation is one part and recession is the other part. So in both parts, you're very well cushioned if you invest in multifamily investments. So what are the factors you can see? The leases are long-term, so 6 to 12 months. Most people who instead of a larger conglomerate commercial leases, which are 3 to 10 years. So you can manage the rental rates based upon the operational cost. If it increases, operational cost increases, you raise the rents, or and you can raise the rents because your leases will expire. Unlike cash and bonds, during inflation, the commercial real estate, the intrinsic value is going to go up, as you know, that because you cannot build more. Sometimes there is not enough land. Annual turnover in apartments shows basically a huge degree of ability to manage the money flow. Now, you do have to manage it, so you need to have excellent operational skills and everything else, not as a passive investor, but as a sponsor who invests directly in those investments and bring it out for your investors. So economists adjusting CPI forecast hard throughout. You can look at it as CPI. This is not like in 2022, early part of the year, people were talking, hey, it's going to be 3 to 4%, the CPI. But then you recently saw the inflation go up to 7.7 to 8%. So you saw that there was a big impact in general on people's pocket as the rates started going up. So what does the recent research report says? There is a 2021, there was a shortfall, construction shortfall of single family homes and apartments compared to new household formations. So it means more people formed an household, but they didn't have a place to live. Now, that's a very simple thing to understand, that if you have a place to live and you can go and provide a safe housing for your family, that becomes a big challenge. If you can't, then that's a big challenge too. Like when I was doing my residency training, we moved to Boston, and I can't tell you, like for 15 days, we were looking for an apartment. We'll go and look at it. We'll say, okay, tomorrow we'll come and sign up the lease. By the time we go next day, it was already rented and somebody had moved in. So when the demand is extremely high and there's not enough supply, it's a tough place to be. The national rental vacancy rates are about 3.1%, which is kind of interesting for you to understand, because it's not that if you have 100 units apartment, then likelihood for them to be vacant is only 3 or 4 units out of it, which is kind of very interesting. It may be a little higher in your area or a little bit even less in your area. So most of the properties we own, they stay pretty full, and that's one of the reasons, because they're not making many of them. And 41.7% of all commercial real estate sales were multifamily, because multifamily is most sought after property for large investors. Why is that? So one is that you can have the appreciating value, you can increase the income, and you can depreciate the property along with the decreasing debt. So the value appreciation once happens, one is natural, the other one is forced. The forced appreciation happens, you go in a building, you make it better, and you renovate, and suddenly the value, something which was renting. I was talking to a colleague of mine. I purchased a 10-unit apartment building, went in, vacated, I think 2 or 3 more people, renovated it. Those people were renting at $950. The first rental he had for his two-bedroom apartment was for $1,750. So think about how you can appreciate the value. Now, along with that, the value, you also see the increasing income. And the reason the value goes up is because the value of these assets are calculated based upon the net operating income and the prevalent cap rates. You can depreciate the property with cost segregation and other stuff, and of course you pay off the debt because your tenants are paying that money. This is some of the data of the appreciation, and this talks about single family, but even in multifamily, you can really increase the value significantly. So even at a 5% cap rate, at any $1 increase in income, you get a $20 increase in value. So if that makes sense to you. Of course, increasing in income, you already know that as the market demand goes up, you basically change your rates and go up in your rent. So one of the things which I have seen in smaller apartment management is that the most of the owners are not very active trying to increase their rates. And within like 2 or 3 years, the rates may be way behind in the market. So if you're managing small apartment yourself and not using a property PM, even if you use a PM company, you still have to keep in mind that you have to take an advantage of regular rent survey and keeping up with the rental increases. So this is salary increase and budgets and structure movement. This is an, you can see shaded areas are basically your recession areas, and as you can see post-recession, there's an inflationary element, and there's the upward movement of the salary, and that also allows the certain element of inflation and also increased income for as increased rental income. So we are focusing on, we're trying to use the wave of something which is increasing. So yes, the prices are increasing. Yes, we can become a dairy farmer. We can start selling vegetables to, and if we have them, that's great. But what we can do easily is we can invest some portion of our cash in an apartment building, and there are multitude of such offerings where you have the ability to invest and use that investment to ride that inflation and allow us to offset some of the cost we are getting in our other areas of our life. So it says you're depreciating debt, but along with the depreciation just given and the real estate appreciating, you pay off the debt each month. So you may not pay off that much debt each month because you want to hold on to the cash because cash is the king. But in general, you are pushing the debt down and also taking advantage of the depreciation. So in general, you need to understand those two portions of it. Now, is this right time to invest in multifamily real estate? And like you can talk about it, whenever there's an economic turmoil and there's a habit, you want to invest in something which is not fluctuating that much, which is not going up and down, which is not moving like 50 points up today and 100 points down tomorrow. And you can figure out how that asset class is going to help you to balance your portfolio. Now, as inflation rises, does your stock value goes up? Means you have to think about it. If you've invested in something which goes up as the inflation rises, hey, that's great. But what I'm saying here is that multifamily investors in general enjoy that as the rental rise happens because of the demand in the multifamily housing units rises. And that's very important for you to understand that, because that's like a basic principle of understanding multifamily, because you can have forced appreciation, you can increase rents and control your operational cost, and on top of that, get benefits from depreciation from the cost segregation study and pay off the debt. So this is a machine which you can set up in the background, which can help you to offset the impact of inflation on yourself and also create a significant degree of wealth across generations. Now, this is not an investment where you're going to go and basically make 200% in a single day. No, this is not how it happens here. So rising interest rate, how would that impact in general? So rising interest rates is kind of like hopeful to a certain degree, because as the interest rates go up, the prices of the houses, they become unaffordable. And there's a higher chance that person will live in an apartment than go ahead and buy their own property. So pandemic after effects. You can see like what has happened. So inflation is of two kinds. One is supply issues, and the other is the demand issue. So the supply chain was impacted, and because of the supply chain impact, that means it really impacted it to such a great degree that construction industry was kind of like paralyzed, like nothing happened for a very long period of time. And then there's a demand supply gap in the sense that there is a huge amount of demand because people need a place to live. And when people need a place to live, there's so many households getting formed, and kids are growing up, they're coming out of college, they're getting jobs, the jobs are there, employment is there. And that's why we kind of focus in the areas where there is an increased job growth, employment growth, and population growth, and also the rent growth. So we focus on those areas where people are moving to. And that's why we identify pockets where we can go and invest and use that to our advantage for a longer period of time, because we can concentrate our operations. We can do things in a very, very cohesive way and manage it in a much better operational. So as you can see, the vacancy remains low. Now, any area, if the vacancy remains low, it means there's so much demand that the property cannot stay vacant. So to summarize, even in this era when the interest rates are going up, I think you're sitting on a kind of like a cusp. So whenever the interest rates started going up, you know that the interest rates cannot stay up for such a long period of time. So when interest rates go up and the value of your assets are under pressure, and as soon as those interest rates start coming down, suddenly the value of your assets balloons up. So it's like a spring. So as the interest rate starts going up, there's a pressure on that spring, and as soon as the interest rates start getting cut, that spring kind of relaxes again. And the reason it will relax again in multifamily is primarily because you have a huge demand. So whenever you look at multiple areas, different areas, you realize that there's significant degree of demand. There's not much supply. It takes about 18 months with permitting and everything, 24 months to get any product to the market. So be aware of that and use that to your advantage to grow your portfolio. Now, what happens in recession? Recession is when economy is shrinking. So people spend money on discretionary purchases. So you may not be eating out every day. You may not be buying 4 things from Amazon, or you may not be getting stuff from everywhere. You focus on an essential. What do you really need? So what you really need is basically housing. Housing is very primary. You need a place to live. You need a place where family is safe. So as long as you provide that, and the real estate can really offer stability when the economy slows, because it's an essential. It's a need. It's not a want. And it's very poorly correlated to stock. So it just gives you a well-balanced element to your portfolio. And as you know, people will still need housing, and recession will create bargain. So it's like you may have chances of getting into opportunities where the rental properties can be purchased at a discount. So overall, inflation may hit, and it has already hit. The Feds are trying to balance it by increasing the interest rates, but that it's impacting our daily life. And how do we get benefit from both of that? Inflationary pressures, take advantage by investing in the rental. So as the rents go up, and like I was talking to a fund manager, a colleague of mine, and they're seeing that their Airbnb collections have gone up from $90,000 to $200,000 a month because they could push the rents for their Airbnb properties. And the same way with the apartments. I mean, last year, we have had close to 8 to 10% on an average in our Dallas portfolio growth in our rental income. So you look at it like how we are going to provide a better place for people to live, provide them a community which they really like and want to be there, and go ahead and use that community for providing income streams for your investors. So as far as I think, that investing in real estate can be a smart way to protect against inflation and recession. If either one of those things are in your mind, it's important that you do that. And with that, I think I have come to an end of this talk, and I'll be happy to answer any questions if you guys have. You can just type it in the chat, and we would be happy to answer those questions. And you can go on our website, www.blueoceancap.com. It's without an E, and there you can find our recent investments, previous investments, and a lot of other resources which you can use.